to you live from the JPMorgan conference right here in Mumbai, and who better than Sanjay Mookim himself to kickstart the discussion on these very hectic 2 days up ahead.
Well,
Good morning.
Thank you for having me.
Thank you for having us. So what's the agenda? A lot of news flow and a lot of debate, I guess. What a time to have this conference.
It is, and I was a bit hesitant to begin with because the market's been lackluster. Let's say it's been flat for a year. But it's a massive vote of confidence. This is the largest ever conference we've organized. Over 1,300 delegates joining us. The number of clients joining us is up more than 30% YOY. We have a greater number of corporates. The buzz is really strong. And like I said, that's a big vote of confidence. Investors saying that, look, we don't care about daily volatility, all this noise that you're referring to. But India does present that long-term opportunity, and people's interests are a little bit more permanent than noise might otherwise entail.
Good to hear that there is still excitement about India. But it's kind of a juxtapose because on one hand you still have uncertainty on tariffs. Over the weekend you had all that H1B news coming out, and then from today onwards, GST 2.0, one of the biggest reforms in the last few years, again kicks off. So what are investors really feeling about India right now?
Well, if I roll this back to a few months, call it late March to June period, there was a sense of despondence in conversations that we were having with investors. Oh, nothing's happening, and it's all looking very gloomy. And the corporate sector were sort of echoing that as well. That has improved to my mind. And the setup for a bounce in Indian equities looks very, very strong to me. I'll walk through a few reasons for this. Our earnings expectations have already been cut, quite a bit actually. Typically, earnings are cut in the later part of a fiscal year, but we've done it ahead of time this year because of that sense of despondence that I was talking about. On valuations, stuff looks very expensive on an absolute basis, but relative to global equities, we are now at a better position. So we've written research on this many times. The India valuations tend to track S&P more than they track EM. Okay, historically the charts are the same. The S&P, PE and ours is the same. Now we are at like a 10% discount to the S&P. So you've got right-sized earnings expectations. You're trading at a discount to global equity valuations. And you have potential domestic catalysts, which is the GST you referred to. Now you may not get a great September quarter out of it because people held up purchases in anticipation. But the December quarter could turn out to be better. So with that, a little bit of a bounce in the market does look like a recent probability to us now.
What are the kind of questions that investors are now asking you in that sense? You spoke about earnings, because we went for an early earnings cut. Normally it happens in the second half, but now I think most of the street is now looking at FY 27 earnings and not 26 because they were almost written off FY 26 in that sense. So what are they looking at in terms of valuation? When you're telling us that we are mapping ourselves to S&P 500 price to earnings and we are at a discount to that. So how are we looking at and how are global funds looking into it?
First, as a word of caution, we should not dismiss FY26. Quantitative correlations suggest that stock prices respond to 12-month forward EPS, not, let's say, the next fiscal. The 12-month forward still relies on some outcome in FY26. There's still 6 months to go, really, right? So quantitatively, the FY26 number still matters. And in another sense, if you cut your FY26 further, you will be forced to cut FY27 as well, right? Because people tend to track these in terms of growth basis. So I do think that the FY26 outcome is still relevant to stock performance. So I personally wouldn't, ignore them and look forward. So if I am now able to meet or even beat the FY26 numbers, that will be a vote of confidence in my corporate earnings outlook. But to your earlier question on what people are asking about, predominantly it is what or which sector can have proper response to price cuts, right? Because you've seen the initial reaction to stock prices. Several sectors have already gone up. What next? Some sectors do I still chase? Where do I get real world impact on volumes for companies, or what's the elasticity really to price cuts for my companies? And that's the discussion, that's the groundwork everybody's trying to do to stay on top of your channel checks, to stay on top of these micro trends in the industry, to see which sectors stroke companies will now really start to deliver better outcomes.
So where is that room for expansion in terms of volumes? Because if you just go by what the market is doing right now, it seems like everyone's just going to make a dash to two-wheelers.
Mm-hmm. Well, the discretionary, as a broader sort of category, does intuitively have greater elasticity to price cuts, right? More than, let's say, staples, and probably far more than commodities. And I agree with you, the market is also reasonably rational. Now, whether it is two-wheelers, whether it is entry-level cars, that's the debate we will have now. But a discretionary cohort is conceptually more, let's say, or stands to gain more from the price cuts that we expect will happen.
So the consumption theme would be broken down into, where is it coming from, right? Either at the base level, which is the entry levels for many of them, or premiumization. And we saw that in the last 12 to 18 months, sachetization of premium brands which is coming in. So do you see that kind of trend to continue, or you're going to see some base level consumption now coming in because of the kind of money which is there?
The hope is for the latter, and I'll tell you why. Because it's not just the cut in GST. You also have to look at the impact of the reduced borrowing costs as rates have come down, and the tax cuts that were implemented in February. So if you add up all of these three and look at the monthly EMI payments for an entry-level car, that's actually come off quite a bit. So you could sort of argue that the affordability of an entry-level car has been pulled up by a year or two. Okay, and that's a meaningful change for a household that was on the edge, that was debating, okay, look, should I borrow some and should I start to, buy my first car? And there is an argument that these changes will tip it over.
Because the inflation that happened in the last 12 to 18 months have eaten into the savings of households. And now this cuts, whether it's a tax cut, an RBI rate cut which has brought down EMI, or now the GST cut, is bringing in that buffer for them. So is the household now going to invest into consumption or into capital markets, or going to put the money into bank FDs?
So I'll refer to RBI consumer sentiment data. Right now, this is soft data, and it's based on a smallish sample, but I find it very instructive. So what the urban consumer sentiment data says is that household sentiment, which was, let's say, 100 pre-COVID, fell to 60 during the lockdowns, went back to 100 in the reopening, and then fell down to 96 or 97. That subsequent collapse is what caught all of us off guard. Yes. So why has that happened? Sentiment on incomes is flat, which we can all relate to, right? So post the reopening, there hasn't been that much of wage growth or income growth. Cost of living has gone up. This is the RBI data again. And cost of living includes your rentals, the school fees, healthcare costs, the inflation, but it doesn't include the consumption cost of living. It's your basic cost of living. And as a result, the ability of people to spend on non-essential goods is now subpar. So the weakness in consumer spending is essentially weakness in non-essential spending. Okay, so our argument, therefore, is that when the government provides this kind of a stimulus, multi-pronged really, it is that variable which should start to move up. The pressure on a household's budget was that we were tightening our belts. So now that I have a little bit of relief, that area should ideally see a bit of an uptick.
But Sanjay, tell me, just the GST stroke consumption fillip, is it enough to bring the FIIs back?
Okay, that's a slightly more complicated question, I would argue. Because a lot of this is in context of what's going on globally, right?
Sure.
All global assets are doing very well. Yeah. In fact, I spent some time over the previous weekend to try and look for equity assets which are below highs on PE.
Did you find any?
No.
Yeah.
That's the point I'm
making.
It's probably only amongst the large caps, it's probably India. Right? Everything else has rebounded so sharply and is doing so well that the impulse for a global asset allocator to suddenly step up and say, okay, now I'm going to add a lot more to India is not very high. A catalyst could help, which is, let's say, if we did get a trade deal with the US and those overhangs were removed, the threat of sanction or oil purchases, etc., went away, then you may get some impulse to foreigners coming in. But I think this is a bit of a circular problem. The market needs to find its feet before you get the flows. The flows need to come in before the market finds its feet a little bit.
The foreign investors as a whole, they've been selling for last couple of quarters there. But it's been supported by the domestic investors who've been buying on a daily basis. In fact, they are outsmarting them in terms of buying. And The reason was that India is overvalued or richly valued at that point in time. The valuation is almost remained the same. The earnings have come up a bit there, but we are still richly valued in that sense. So how is the foreign investors now looking at? They expected a correction in the valuation to come back into the market, and that's not coming.
The relative valuations have gotten better, and that's the point I was making. Because global equities have gone up, our valuations do not look as bad as they did. And more important is if you now split it into sectors, right? Let's take the financials cohort. Our banks, even in a slowing economy, will still deliver a certain degree of earnings growth with a high degree of confidence for the next 3 years. But look at what's happened to global financial multiples. All global banks have been on a secular rally this year. And if you look at India financials premium to global financials, it's actually come off quite a bit, right? So in contrast to what's happening in the rest of the world, our valuations do not look as prohibitive as they were, let's say, early 2024.
But will that lead to money coming in?
Again, it needs a spark, I would argue. So now when you have rest of EM, rest of Asia doing so well, and people are engaged more in looking for opportunities in markets which have momentum at the moment, there is no real impulse immediately. So the first precondition would be for the rest of EM or rest of Asia to lose some momentum before the focus shifts back to India.
We've seen momentum going into China, Taiwan, Vietnam, and
Korea.
And Korea. But is there going to be reversal from those countries to come back to India?
I wish I could be so precise, to be honest. I wouldn't be sitting here.
My question is also with respect to tech, and that's a theme which has come over the weekend. The tech has been slow since last September. Discretionary spends falling off. Then Trump coming in, tariff wars. Multiple headwinds for this sector, and the final one coming in with the visa. How do you see the tech sector as a whole?
I think the development of the weekend is still evolving, and we'll figure out exactly the details of it and B, how companies respond to it. Maybe some onshoring is possible, but like I said, we do not have enough information here to take a very hard view on this outcome. But let me make a slightly broader comment. See, what's happening globally is that the whole trade structure, the integrated supply chain, is now being dismantled to a degree. Countries that relied on export or that trade will lose drivers of growth. And growth globally will become more scarce over the next few years, right? India is a country which actually has endogenous growth drivers. Even though my growth will likely slow because my linkage to the world is not zero, I still have exports, and those exports will likely come under pressure. But I am not entirely reliant on it. I still have a lot of very strong domestic growth drivers. So the alpha on growth in India structurally for the next 3 years will actually improve because countries which are more dependent on exports will actually run out of steam faster. So on a relative basis, India will be one of the few large economies which will still have some visible growth over the next 3 years.
So as an investor, if you were to make a portfolio fresh based on this premise about, the domestic story being so strong on India and lesser reliance on export-oriented economies, what should be my biggest sector, overweights and underweights?
So let me answer that question two ways, right? If you're a 3 to 5 year investor, you look for compounding growth. Right?
Sure.
The growth expectations will need to be watered down a little bit, right? One, because the economy itself is a little bit slower. Just take the stark contrast in nominal GDP growth. It was north of 20% FY23. It's now probably going to be 8%. And there isn't a view that this 8 is going to 12 in a rush. It probably goes to 9 or 10 over the next 3 years. But we are in a more subdued economic growth activity, which will therefore dampen the earnings growth and therefore possibly equity returns. The other argument we make is that shorter-term returns are made on earnings surprises, not growth. We've done a lot of quant work on this. And if you're an investor for 12 months or less, you are looking for companies that are going to beat expectations of growth. Right now, that appears difficult as well because, yes, things have gotten right-sized on the forecast, but do I have enough momentum for a large set of companies to surprise me on earnings? I don't see that yet. So my suggestion is, it is still a better asset to own in the India context, especially given the tax structure that we have locally. But do not expect a high double-digit compounding return from an India equity portfolio over the next 3 years. If I make 9% in equities in an index ETF, I should be happy with it. It's a good return.
And what should my sector composition be?
So we prefer financials on that, like I said, because there is a high confidence of even, let's say, subdued growth relative to history, and I'm getting these stocks at a much better valuations relative to what financials are trading elsewhere in the world. We like the consumer space. We've talked a lot about it so far because there is enough of a stimulus. A couple of sectors we like on the side is we like real estate, we like power, we like the defense stocks. So we have those idiosyncratic bottom-up picks as well. But on a core basis of financial stroke consumer discretionary makes a lot of sense.
Sanjay, a lot of new money has not come into the secondary market, but new paper which is coming, whether it's IPO, whether it's block deals or PE exits, everything. Do you see this trend to continue in this year as well?
Must. Because that is the function of market.
Because that's not bringing in the momentum in the secondary market. It's just absorbing the liquidity and then, the momentum that needs to...
We don't need momentum. Why should we? It is not an imperative, right? The function of the equity market is to take savings and provide it to corporates who will use those savings to grow assets, right? And the equity market is discharging its function because there is money coming into mutual funds or through retail, and it is being transferred to corporates through all these listings and IPOs. Now, some of it is our exits, but again, that's recycling of capital. So what is happening is exactly what the market is designed to do. And as long as there is supply of money, there will be a demand of money. If the market has to balance out.
And the secondary market function where trading, where the FI volumes come in the secondary market as a trading volume, that's something which is much lower today compared to maybe a year or two back, right? In that sense.
See, again, if you step back, and again, we return to research on this, on a daily basis, the net flows are zero. Right? There's as many buyers as many sellers, right? Why does the market go up or down? It's on the impulse of the buyer. If the buyer is more aggressive, the market goes up. If the seller is more aggressive, the market goes down. So I think a lot or too much of an excessive focus is put on the flow analysis. If I may be a bit harsh, that's like chasing your tail, right? We cannot invest on the anticipation of flows. We have to invest slightly more fundamentally. And like I said, India it's much better in the context of where global equities are today.
And how does it change your coverage platform? Because MSCI India, few years back had 80 stocks, now 160 stocks. The expansion of stocks which are coming in, foreigners now looking at more alpha in many new stocks which is there. How does it change as a brokerage, how do you look at that actually?
Well, thank you for the question. It gives me an opportunity to plug myself a little bit, right? Because JPMorgan has invested a lot in its equity franchise in India. A few years ago, we were covering somewhere around 125 or 130 stocks. I'm within short of being 190 stocks now because the impulse is right. The market is growing. The expansion of liquidity is durable. It's here to stay. And it is imperative upon me as a brokerage to stay competitive. We are, if I remember my number right, a top 3 foreign broking house in terms of stocks covered now. And there is a clear emphasis from all the senior management at JPMorgan to continue to stay invested in India, to grow our investments and increase our footprints in the economy.
Mm-hmm. And India will always be a stock pickers market anyway, right?
Yes. Again, to be very harsh, India used to trade 3 billion a day in 2019. Even though the market's soft now, I'm still trading 12 billion a day. There's 200 odd stocks which have F&O, a lot of liquidity, a lot of hedge fund interest. So things have structurally changed. The economy will go up, it will go down, the market will be flat and then not flat. But there is a structural change in the size of the equity market, and it is imperative for us as participants to respond to it.
But for this fiscal year, you're expecting new highs, right? Better than the previous high.
Logically, it should go up every year, to be honest. Our target is 26,500.
And over the next 12 months?
Next 6 to 9 months.
And you'll have short-term peaks coming in, volatility? Because you have a couple of events coming in, India, US trade and others, there's other resolutions that comes in. Is that going to bring in some kind of, impulse into the market, as you say?
I do think markets tend to be mean reverting, so the premise might prove to be correct. But again, it's impossible to be precise.
Okay, Sanjay, on that note, we'll let you go. Thanks for your time. Thank you.
Great being here. Thank you.
All the best for you.
Thank you.
पैसा लगाना है तो सेंचुरी क्लब प्राइम पे लगाओ। डूबेगा नहीं, जलेगा भी नहीं, कोई खा नहीं जाएगा, धोखा नहीं देगा।